In the world of Bitcoin, every week is a roller coaster ride. Imagine strapping yourself into a rickety wooden coaster, the kind that gives you a thrill, but also makes your stomach do flips. That's what it's like to keep track of Bitcoin's price. This week, we've seen it soar sky high, then plunge down into the depths, only to rise again, all in the blink of an eye. It's like being on the world's most intense ride, except instead of screaming in excitement or fear, you're furiously checking your phone, hoping the price has skyrocketed rather than plummeted. One moment you're the king of the world, the next, you feel like you've been tossed overboard into a stormy sea. But that's the thrill of it, right? The exhilarating unpredictability of it all. It's a game of high stakes where the brave and the bold can win big, or lose it all. Let's rewind to last week. Remember how we were cruising along at a steady pace? The price was stable and it seemed like we were in for a smooth ride. But then, out of nowhere, we hit a loop-de-loop. The price shot up, and for a moment we were flying, but just as quickly, it dropped, leaving us all gasping for breath and clutching our hearts. And this week? Well, it's been a wild ride. We've seen the price climb to dizzying heights only to dive back down again. It's been a roller coaster of emotions, a thrill ride that leaves us both exhilarated and exhausted. But that's the beauty of Bitcoin. It's unpredictable, volatile, and utterly thrilling. It's the roller coaster ride that never ends. And that's just another week in the life of Bitcoin. But hold on to your hats because we've got some major news coming up. This week, the eyes of the crypto world are fixed on the Supreme Court. Yes, you heard it right. The Supreme Court case of Moore v. US is making waves and could potentially redefine the taxation of digital assets. We're talking about cryptocurrencies, those fascinating digital tokens that have revolutionized the financial landscape in recent years. Now, what makes this case particularly interesting is its focus on unrealized gains. For those of you who might be a bit rusty on your financial lingo, unrealized gains refer to the increase in the value of an asset that an investor holds but has not yet sold. Traditionally, these gains are not taxed until they're realized, that is, when the asset is sold. However, Moore v. US is challenging this convention, questioning whether these unrealized gains should be subject to tax. The implications of this are huge, especially for crypto enthusiasts. Imagine having to pay taxes on the increased value of your Bitcoin or Ethereum holdings, even though you haven't sold them yet. Sounds a bit daunting, doesn't it? But why is this case so important to the crypto world? Well, as you may know, the interpretation of realization in cryptocurrency remains a contentious point. Many crypto investors have faced unexpected tax liabilities due to trading cryptocurrencies, causing quite a stir in the community. The outcome of this case could set a precedent for the taxation of cryptocurrencies and other emerging asset classes. It could either be a boon or a bane for crypto investors, depending on which way the decision swings. As we speak, the Supreme Court is gearing up to hear the case on December 5th. The verdict could potentially influence the way digital assets are taxed and reported, which in turn could impact the future of cryptocurrency investments. In the meantime, the crypto world watches with bated breath, anticipating the outcome of this landmark case. Will it bring about a tax revolution or maintain the status quo? Only time will tell. And as always, we'll be here to keep you updated on the latest twists and turns in the ever-exciting world of cryptocurrency. As the Supreme Court prepares to hear the case on December 5th, the crypto world watches with bated breath. So buckle up, folks, because it's about to get really interesting. Meanwhile, there's another storm brewing. The IRS's proposed digital asset broker reporting regulations. Now, let's take a moment to unpack that mouthful. Essentially, the IRS wants to redefine what it means to be a broker. Traditionally, a broker is someone who facilitates transactions between buyers and sellers. However, the IRS is looking to expand this definition to include anyone involved in the transfer of digital assets. That's right, anyone. The implications of this are far-reaching. It would mean that anyone in the crypto space, from exchanges to individual traders, could be considered a broker. And as a broker, you'd be required to report transactions to the taxman. This could create a whole new level of complexity when it comes to reporting and taxation. Now, this proposition has ruffled more than a few feathers. Major players like Coinbase have voiced their concerns, arguing that these regulations could be overly complex and invasive. Imagine having to report every single transaction you make, no matter how small. It's enough to make your head spin. But it's not just about the burden of reporting. There are also concerns about privacy. In a world where data is the new gold, these regulations could potentially expose sensitive information to prying eyes. So, What does this mean for the world of crypto? Well, it's still too early to tell. The IRS's broker rule is just a proposal at this stage, but if it does go through, it could fundamentally change the way we navigate the crypto space. As we navigate these choppy waters, one thing is certain: the landscape of cryptocurrency reporting and taxation could be in for a significant overhaul. Now, what happens when these two events collide? Imagine a meteor and a comet on a crash course, both bringing their own set of cosmic rules to the table. That's the kind of seismic shift we could be looking at when the outcome of the Moore v. U.S. Supreme Court case meets the IRS's proposed broker rule. First off, let's talk about the Supreme Court case. It's all about the tax treatment of investments and whether unrealized gains should be subject to tax. Now apply that to the digital gold rush we're all part of. If the Supreme Court decides in favor of taxing unrealized gains, your digital wallet could be in for a bit of a shock. It's like taxing a farmer for the apples still growing on his trees. On the other side of the cosmic collision, we have the IRS's proposed broker rule. This new regulation aims to expand the definition of broker for tax reporting purposes. But here's the kicker: it's not just about the traditional brokers anymore. The rule could apply to cryptocurrency exchanges, wallet providers, and yes, even peer-to-peer platforms. Now the crypto community has raised valid concerns. They're worried about overcomplication and invasiveness, and can you blame them? The idea of Uncle Sam peeking over your shoulder while you trade your Dogecoins doesn't exactly scream financial independence, does it? So what happens when these two celestial bodies crash? Well, we could be looking at a complete overhaul of cryptocurrency reporting and taxation. The implications could be earth-shattering, or they could be a damp squib. Only time and the Supreme Court will tell. The future of crypto taxation is hanging in the balance, and all we can do is wait and watch. So, what does all this mean for you, the crypto enthusiast? Well, it's a roller coaster ride, isn't it? We've talked about the Supreme Court case of Moore v. U.S., the potential redefinition of the term broker, and the possibility of a crypto tax revolution. All of these could significantly impact the landscape of digital assets. Let's break it down. The case of Moore v. U.S. could redefine how we view unrealized gains in investment, particularly in cryptocurrencies. Should the court rule that these gains are taxable, it could mean a considerable change in how we manage our digital assets. We might need to think twice before making those hasty trades or cashing out on a sudden surge. Then there's the IRS's proposed broker reporting regulations. These could expand the definition of broker for tax reporting purposes, making it a broader term than we're accustomed to. This could mean more stringent reporting requirements and potentially higher tax liabilities. Companies like Coinbase have already expressed concerns indicating that these regulations could be overcomplex and invasive. So, what's next? Well, that's the million Bitcoin question, isn't it? These developments could lead to a complete overhaul of cryptocurrency reporting and taxation. As enthusiasts, we should be prepared for these changes. They could affect how we trade, invest, and even perceive digital assets. However, remember that the world of crypto has always been one of constant change and innovation. It's what makes it so exciting and unpredictable. So, even as we face these potential challenges, let's not forget the opportunities they could bring. More regulations could mean more legitimacy for cryptocurrencies, attracting more investors and potentially driving up prices. In the wild world of crypto, one thing's for sure: there's never a dull moment. Until next time, keep your eyes on the charts and your fingers on the pulse.